There's a method called tax avoidance that the rich use to keep getting richer, which you may have heard. The Fed says that in the third quarter of 2023, the wealthiest 1% of U.S. families based on income own 23.3% of the country's wealth, up from 22.8% the previous year. It was found that the top 1% of individual earners had an average tax rate of just over 26% based on their adjusted gross income. When you evade taxes, you can go to jail. But when you avoid taxes, it's legal and you can use it to lower your tax bill no matter how much money you make. Rich people use common tax loopholes to lower their yearly tax bill. All you need to do is learn how to use them. There are 8 ways to cut your tax bill even more. Number 8. Make a depreciation claim. Rich people can save money on taxes in a number of ways. So, what is it really? For federal income tax reasons, depreciation is a deduction that lets you get back some of the money you spent on property, tax expert Kelly Phillips Erb wrote in a Forbes article. It can be tricky, but in general, when you put your property to use for the first time, it starts to lose value. The IRS says that property is placed in service when it is ready to be used, not when you start using it. Unless there is an exception, you write down the cost of a thing over the time it can be used based on the type of property. Both physical and intangible property can be written off as worn out. Buildings, rental properties, tools, cars and trucks, furniture, equipment, patents, copyrights, and some types of software may all be able to get this deduction. Number 7. Take out business costs. You could get big tax breaks if you run a business. When business owners file their taxes, they may be able to subtract some costs related to their business. These include costs related to planning your trip, the vehicle, items for the office, school costs related to work, a place to work from home. But not every project can be considered a business that can get these kinds of tax breaks. To be eligible, you must plan to try to make money from your business and not just do it as a hobby, according to the IRS. But sometimes it's hard to tell the difference between work and fun. Being aware of the difference is important so you don't miss out on a valid discount or claim one that you don't deserve. Number 6. Get your kids to work. For business owners, making their company a family affair can help them make more cash. For instance, you might be able to get tax breaks if you hire your kids to do real work for you in your business. When talking about partnerships and single proprietorships that parents of a child own, the IRS said, payments for the services of a child under age 18 are not subject to Social Security and Medicare taxes. Plus, your kid's income won't be taxed unless it's more than the standard deduction. For tax year 2023, the standard deduction is $13,000. For tax year 2024, it is $14,000. You can get a tax break when you hire your kids to work for you because you can write off their pay as a business cost. Instead of paying a lot of taxes on the money you make from your business, give some of it to your child as payment for work they do. But the work your child does must be legitimate and the pay must be reasonable, according to Gail Rosen, a certified public accountant from New Jersey. Number 5. Carry over lost business. Rich people sometimes lose money in business, but they keep the money they lose and use it to buy other things. A net operating loss carry-forward rule from the IRS lets business owners who lost money in one year carry that loss forward to a later year when the deduction would be better. It's possible for a business to lose money, which is known as net operating losses, NOL. Usually, you have an NOL when your tax deductions are higher than your taxable income. Some years that number has been positive, which means tax has been due, but not this year. That doesn't seem fair. The NOL is there to make up for that unfairness. This means that the loss you have one year can be used to lower your taxable income in your tax bill the next year. The IRS let people carry back their NOLs from tax years 2018 to 2020. First, they let you carry back the full NOL amount for up to 5 years. Then, if they still had an NOL left over after carrying those losses back, they could take those losses forward. From the 2021 tax year on, most businesses will only be able to carry those losses forward. A carry forward means that you can use the loss to boost your income the following year. Erb put it in writing. Number 4. Don't depend on your job to make money, invest it instead. Smart people can make their money work for them instead of them having to work for it, said Eric J. Nissel, an accountant from Pompano Beach, Florida. Real estate investment companies, REITs, and master limited partnerships, MLPs, are 2 types of investments that are set up in a way that can bring in a steady stream of income. Investors can also buy stocks or real estate and buy rental homes as an alternative. Keep in mind that you'll have to put a lot of money into the business before you see any returns, and you can't be sure of those returns. Up to 37% of earned income can be taxed. Invest in stocks that pay regular payments and get money from the companies that issue them. After the stock has gone up in value, you can sell it and pay a relatively low capital gains tax rate. The long-term capital gains tax rates are 0%, 15%, or 20%, depending on how much was made in a given year. You may be able to reduce your property taxes if you own a home that you rent out. Be aware, though, that you need to rent to people who will do the right thing and pay their rent on time. Repairs that need to be done right away and regular changes can also cost a lot. Number 3. Sell the house you inherited. It is possible to pay less in capital gains taxes if you inherit a piece of land. This is called step-up in basis. Usually, you'll have to pay taxes on the $250,000 gain you make when you buy land for $200,000 and then sell it for $450,000. But if your parents buy the land for $200,000 and you inherit it, the fair market value of the land at the time you inherit it will be your new base. You won't have to pay any taxes on that $250,000 gain if you sell it right away. A stepped-up base is a process that is done automatically on all property that is passed down through inheritance. For tax reasons, it's the same as buying the property all over again at the present price. To use the earlier example, if your parents die and leave you their property, you will not have to pay capital gains tax on the $250,000 increase in value when you sell it using the step-up basis. But watch out that your parents don't give you the land before they die. If they do, they'll have to pay a lot of taxes all their lives and you won't get nearly as much money from them. Number 2. Get full coverage for your life. Life insurance is usually linked to the need to take care of your loved ones after you die. People with a lot of money buy whole life insurance as a secret plan. It's like having both an insurance contract and an investment account at the same time. As your insurance grows, you can get growth that isn't taxed right away. You can also get payouts that aren't taxed if certain things happen. The rich person who owns the insurance gets this tax break for life, which is an added bonus. When they die, the policy benefit amount goes straight to the lucky recipient they chose, and they don't have to pay any taxes on it. Talk to a licensed and experienced insurance agent or financial planner. Also, talk to a professional to see if whole life insurance is correct for you. Some experts say it's not a good investment in part because the fees are so high. Number 1. Get a boat or second home. Most people in the US don't have enough money to buy a boat or a second home. Rich people can lower their tax bill though they have more than one home. How to get the tax break? Most of the time, you can deduct the property taxes and mortgage interest you pay if you own a house and list your deductions page by page. However, the most that taxpayers can deduct for property taxes is $10,000. If you buy a second home, you can also reduce the taxes and mortgage interest that go along with it. The IRS says that a boat can be a home as long as it has a place to sleep, a kitchen, and a bathroom. If you can afford a second home, especially an expensive one that moves, this plan probably won't work for you. There are tax breaks for people who own their own homes, even if they only have one. Subscribe to our channel for more insights. Thanks for watching.